The head and shoulders chart pattern is widely recognized and easily identified in technical analysis. It's a specific chart formation that predicts a shift from a bullish to a bearish trend. As a trader, you're probably familiar with this head and shoulders pattern. However, unfortunately, many traders aren't exactly sure how to correctly utilize signals from the head and shoulders pattern. It's a pity because head and shoulders signals have a very high probability of success if you know how to use them. Therefore, in this video, I'll demonstrate how to triple the accuracy of the head and shoulders chart pattern to ensure our trades are profitable in both the short and long term. Head and shoulders pattern attributes. Before engaging in trading using this pattern, you need to understand its main attributes first. By doing so, you can easily identify the most advantageous trading positions. Let's delve into each step in more detail now. Step 1. Uptrend. The first part of the head and shoulders pattern is the uptrend. It is an upward movement that eventually experiences exhaustion. As a general rule, the longer the uptrend persists, the greater the likelihood of a reversal. Step 2. Left shoulder. The market moves down, forming a higher low. At this point, everything looks good, but there is not enough funding yet to determine its limit. Step 3. Head. After the left shoulder is formed, the market reaches the highest point, forming the head. Despite a bullish rally, buyers cannot reach a much higher low. At this point, the structure of the left shoulder and head is formed. Although the neckline starts to form, we still need the right shoulder before drawing the neckline on the chart. Step 4. Right shoulder. The right shoulder is where everything comes together. It indicates that buyers are tired, and the market may be preparing for a price reversal. As soon as the right shoulder begins, we have enough funds to start drawing the neckline. However, since the pattern is not yet complete, it is advisable to consider it as a rough draft, not the final version. Step 5. Neckline. The neckline is a support or resistance level used by traders to determine strategic areas for placing orders. To draw the neckline, the first step is to locate the left shoulder, head, and right shoulder positions on the chart. In a standard head and shoulders pattern, or market top, we connect the low price after the left shoulder, with the low price formed after the head. This creates our neckline. The importance of the neckline will be discussed in the next section. In an inverted head and shoulders pattern, we connect the high price after the left shoulder, with the high price formed after the head, thus creating the neckline for this pattern. Note: formations are rarely perfect, meaning there may be some noise between the shoulder and head. Benefits of trading the head and shoulders pattern. If you've been exploring the market for a while, you may have studied various chart patterns. You might even be wondering which pattern to focus on. So, let me tell you that the smartest trading pattern is the one that stands out to you the most. It's the pattern that catches your eye and that you recognize. It could be the head and shoulders or a number of other patterns. However, there are several benefits to be gained from the head and shoulders pattern. First, almost every professional trader will know what you're talking about with this pattern. It makes it easy to discuss it within your trading community. Sometimes you need a second opinion whether in a trading chat room or on social media. Second, the head and shoulders pattern is identified when a change in the trend direction occurs. If you know what you're doing, you potentially can find trade setups that meet strong risk-reward criteria. The third reason to trade this pattern might be the best one. It can help you determine where to place your entry targets, stops, and profits based on logical price movements. How to trade the head and shoulders pattern. Regardless of the chart pattern that suits you, whether it's the head and shoulders, pennant, double top and double bottom, flag, or anything else, it's crucial to have a process for each trading setup. Here are 5 simple and effective steps on how a savvy trader approaches trading with the head and shoulders pattern. Step 1. Identify market trend. When first looking at a chart, you want to determine whether the market is in an uptrend, downtrend, or consolidation. Determining the trend early on can help you develop a game plan more quickly. You'll roughly know what the stock is doing, making it easier to identify low-risk trading setups. So, whatever you do, remember to determine the overall trend before doing anything else. Step 2. Before making any trades, it's important to let the head and shoulders pattern complete itself. If the pattern appears to be forming or is in the process of forming, you should not assume that the pattern will fully develop and trade based on what you believe will happen. Remember, trade what you see, not what you think. It's crucial for traders to wait for the pattern to complete. This is because a pattern may not develop at all, or a partially developed pattern may not be complete in the future. Partial or almost completed patterns should be noted, but trading should not be done until the pattern breaks through the neckline. So, remember to pay attention to the developing trend and be patient. Try not to get caught up in excessive anticipation. Step 3. Trade the pattern. Trading can commence once the pattern is complete. Plan your trade in advance, write down entry targets, stop loss, and profit, and note any variables that may alter your stop loss or profit targets. For the head and shoulders pattern, we wait for price action to move lower than the neckline after the peak of the right shoulder. For the inverse head and shoulders, we wait for price movement above the neckline after the right shoulder is formed. Another entry point requires more patience, and there's a possibility that the move might be missed entirely. This method involves waiting for a pullback to the neckline after the breakout occurs. It's more conservative as it allows us to see if the pullback stops and the early breakout direction continues. However, the trade might be missed if the price keeps moving in the breakout direction. Step 4. Place your stop loss. The stop loss is placed just above the right shoulder after the neckline is breached. Alternatively, the top of the pattern can be used as a stop, but this likely carries a much higher risk and thus reduces the risk-to-reward ratio of the pattern. Step 5. Set your profit target. The most common and often recommended profit target is the distance between the head and the neckline. And how does that translate into a risk-reward ratio? Since our first profit target or minimum is the distance between the head and the neckline, if we decide to use a conservative option for stop protection, then we will have the same distance as the loss limit, thus creating a minimum risk-reward ratio of 1:1. This is why, to improve this ratio, most experienced traders often place their protective stop above the peak of the right shoulder, considering they use the head to neckline profit target. However, one thing that should always hold true is a favorable risk-to-reward ratio. So always make sure to calculate before making a trade. Trading head and shoulders with moving average and stochastic oscillator filter. After understanding all aspects of the head and shoulders pattern, let's now discuss how to improve trading accuracy with head and shoulders. Head and shoulders is one of the most popular chart patterns among forex and stock traders. However, as traders, we must always strive to secure our transactions. One of the most effective ways is to increase the accuracy of the head and shoulders pattern to ensure that the trading we do will provide maximum returns. Why stochastic oscillator and moving average? Head and shoulders pattern is a high accuracy trading signal. Meanwhile, stochastic oscillator and moving average are indicators to diagnose market conditions when the head and shoulders signal forms. Diagnosing stochastic oscillator. The purpose of the stochastic oscillator is to ensure that the head and shoulders signal forms when the market is in oversold or overbought conditions. If the head and shoulders pattern signal forms simultaneously with the market price movement in oversold or overbought conditions, the probability of trend reversal becomes higher. Diagnosing exponential moving average. Moving average is a trend indicator. If the price is above the moving average line, it means the market trend is bullish. Conversely, if the price is below the moving average line, it means the market trend is bearish. In this strategy, we use the EMA indicator with a period setting of 14, because this period represents the average price movement formed by the head and shoulders pattern. The period of 14 also matches the setting of the stochastic oscillator, which is 14:3:3. So, now how do we trade the head and shoulders pattern using the stochastic oscillator and moving average filter? Short setup. Rule number 1. Market movement forms the head and shoulders pattern. All head and shoulders rules have been discussed above. Rule number 2. When the head and shoulders pattern forms, the stochastic oscillator is in the overbought area. Rule number 3. We wait for price action to move lower than the neckline after the peak of the right shoulder. Rule number 4. Price is below the 14-period EMA line. Rule number 5. Open a sell position with stop loss above the nearest swing high. The minimum profit target is the distance between the head and the neckline. Long setup. Rule number 1. Market movement forms the inverse head and shoulders pattern. Rule number 2. When the inverse head and shoulders pattern forms, the stochastic oscillator is in the oversold area. Rule number 3. We wait for price action to move higher than the neckline after the valley of the right shoulder. Rule number 4. Price is above the 14-period EMA line. Rule number 5. Open a buy position with stop loss below the nearest swing low. The minimum profit target is the distance between the head and the neckline. With this explanation, you now know that the best way to trade the head and shoulders pattern is by using the stochastic oscillator and moving average filter. By utilizing this filter, the probability of our trading success becomes 3 times more accurate than if we only rely on the head and shoulders pattern signal alone. So, if you want to implement the exact setup of the head and shoulders trading with EMA and stochastic oscillator filter demonstrated in this video, you can download all the templates and indicators from the description section below this video. I've included a template with the system that you can effortlessly add to your chart, automatically plotting all these indicators accurately. This way, there's no need for any additional hassle. Look for the download link in the description. Here are other examples of how to trade the market using the head and shoulders pattern signal with EMA and stochastic oscillator, to fully understand this wonderful strategy, and to make the most out of it. Head and shoulders is one of the most effective price action strategies you can use in the market. This system provides a method for trading the market based on logical price movements. It's very easy to identify entry targets, stops, and profits, making it an effective strategy for both beginners and professionals. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.